Me is Aishwarya Dadhich, who's the founder and CIO at Fident Asset Management. Great to have you on the show, Aishwarya. All-round cheer, economic growth has topped estimates. It has topped RBI estimates by a wide margin. 6.5% is what the RBI had penciled in. Exit poll predictions, throwing out no negative surprises. Earnings-wise as well, it has been a fairly good ride when you look at the second quarter. From here, would you say that there's a substantial leg up waiting ahead, or would you say that we could look at a consolidation as is the case after every big up move? How are we poised for the next few weeks?
Good afternoon, Nandita, and thanks for having me here. I would say it's become a potpourri of good news for the market, especially the equity market. And it all started from the US when we saw the softening of yield, because of those inflationary data which came out. And then back home, we saw very strong macroeconomic indicators, especially what we saw GDP number yesterday, is putting a lot of, fuel to the fire of the market. But obviously, the one risk which I personally, we discussed it last time also, that, possibly FI are holding back on account of the uncertainty of, the election, the state election and the outcome which it will have. We saw a relatively sanguine data with the policy continuity perspective of this government is also adding a lot of support to the market recently. So I believe, the market sentiment is very, very strong, and globally the risk-on sentiment will have a rub-off of impact on India. Specifically coming on India side, we saw the election, the exit poll, and which are basically in favor of this the existing government. But it's a little bit foolhardy to assume that that exit poll are definitive. We have seen in the past that this can turn around anyway, and if we see there would be any deviation from what the market is expecting, then there could be an area of consolidation which will be there in the next weeks. So initially, so far, things are looking great, but I won't say that completely relying on exit poll would be a great idea. Second is, even if you say last time, 5 years ago, when the exit poll were in completely, different than what the actual results were. And second most important thing is whether state election has a very strong, I would say, a connection with the national election. That is also not the case there, right? So if you look at the state election last time and the way the national election came out with a thumping win, it's very, very difficult to put or extrapolate things from that perspective. So for an investor, it has to be very sure that possibly this election can put some fuel to the fire and can create some sort of havoc in the market, especially in sectors where we have seen a policy continuity as an important determinant factor where valuations have gone up much, much higher to the comfort. But if that plays out well, I believe we can see a very strong rally in the market post Monday. So if you see a good set of results which says that there is possibility continuity of the government and the continuity of the policy, I will not be surprised to see market reaching new highs in the coming months before the final election spreads out.
All right. So I know you don't talk levels, but 20,500, would you see that as a distant possibility, or do you think that's very much on the cards by December end?
So this short term is going to be difficult for me, but if we have sailed through Monday and if the results comes in line with what is market expecting, I will not be surprised that it can be covered in a week or a jiffy. So I will be not surprised to see market moving up at least says 5 to 10% in the next 3 to 4 months if we have favorable state election outcome given other constraints remain as it is. So why I'm saying so, if you look at valuation, there's a lot of talk about markets are in a frothy valuations mode and things like that. But if you really look at the valuation numbers of Nifty, they are not at, I would say, skyrocket levels. If you look at the next year valuations are a little close to 20.5 times, and 25 is not even more than 19 times. And if you see history, we have seen valuations going up 24, 25 times when possibly macroeconomic indicators were not that strong that we are seeing today. So I would be very, very sure that, we could see much higher level in the market if this state election comes into favor, and the quarter 3 and quarter 4, I would say the earnings season plays out even what we have seen in the last 2 quarters. And Nandita, last but not the least, if you just saw the number on GDP, I want to really bring this point to all of the viewers here that one of the biggest contributor to the GDP number yesterday, even in the last 2 quarters, we did almost 7.7% growth year on year in this first half. And the biggest contributor is possibly the gross fixed capital formation. If you see the last 6 quarters, the kind of government capex has contributed in the government expenditure, both 11 and 12% year-on-year growth. I believe we are going to see very strong numbers for GDP for the next 2 quarters also. I won't be surprised to see that, we even put a 7.8, 7.9% the whole year number for FY24. And if the consumption of private picks up, this number can be sustained, not exactly, but I would say very healthy number can sustain in FY25.
But Aishwarya, going into election year, of course, government spending will slow down a bit. And as we saw, private consumption has already slowed down. There is evidence of that as well.
Yeah.
So second half growth is expected to slow down a bit. So in that sense, do you think the market has factored that in? Or do you think it's just initial euphoria after looking at that 7.6% figure?
No, so I think it's a very valid point, but I believe the manufacturing, the services could easily do 8 to 9% growth year on year, and on top of it, the private, the public, I would say the government expenditure will able to pull up the trigger. We understand that, as I said, private consumption is definitely slowing down, especially in the rural side. Even we will see this number today on auto numbers, but I think there will be a above impact for the slow rural side. But with these elections around the corner, the rural spending possibly can see some uptick in the coming couple of months before there is a structural play out. So yes, we are watchful about how the rural side and the private consumption picks up. But my point is, it possibly will not derail the whole GDP growth theory for the next 2 quarters. So as the three important element of services, manufacturing and government expenditure and the government capex should be able to sell it to about 7% easily for the next 2 quarters. That's what we believe strongly.
Right. Talking about the rally in the broader markets, mid and small cap indices have gained somewhere around 30 to 50% on a YTD basis. And we've heard a lot of experts pointing out that valuations are stretched, they are frothy, at least when it comes to the broader markets. But we've still seen mid and small cap indices hitting fresh highs almost every other session, right? So, do you think they deserve higher valuations than what is right now, or do you think they are pretty much overheated?
So, I believe they are pretty much overheated, and the reason is, I would say they are more in couple of sectors which is seeing a lot of valuation, I would say fraud which has built up. Right, so there's a theory about, especially if I may say so, the defense is one of the sectors, or railway is another sector where we have seen valuation which has completely gone out of the roof. But to be honest and to give credit to the government, the kind of capex, that they have been announced and the capex that is played out and the revenue which we have witnessed in the last 4 to 6 quarters is building a very strong story, for the next 3 to 4 years growth, and possibly then we can be able to justify the valuation which are there. But we should not forget that, as I said earlier, that policy continuity is very, very critical here. If we see a change in government anytime in the middle of the next year, possibly the quantum of expenditure or possibly the mindset change could possibly derail those valuation big times. So in that case, I will ask all the viewers to be very, very careful and cautious in some of the sectors where policy continuity is of paramount importance, where valuation has gone over the roof. Even if I see sectors apart from defense and your rail, many other mid cap sectors are possibly at stretch valuation. So one has to be very sure that the kind of earnings that the visibility that these companies have are in sync with the valuation. So anything above 1.5, 2 time PEG ratio for any of these mid and small cap companies, one has to be very, very careful. Until unless you are seeing possibly that there is a complete structural change or that earning trajectory is very, very solid. Even if you see changes in economy or in government for the next 1 or 2 years, then they should put hold to it. But I think in mid and small cap, especially in small cap, Nandita, things are really getting very, very frothy. So one has to be careful, and incremental buying has to be very, very cautious. Right? What happens is normally majority of the money of retail investors comes when markets are in such mode, and that is the time most of the institutional investors and the buyers are booking up. Or going out. So if I look at, say just to give an example, say Hero MotoCorp. Possibly the kind of rally, even being a large cap in the last couple of sessions, is something which is difficult to believe. Because if you see the last 7 8 years, Hero Moto hasn't moved much. But you see the kind of momentum which we are witnessing is surprising. Even if you see what happened with the yesterday IPO, so there's definitely kind of exuberance, the kind of over the top excitement in the market, especially because of the retail side. And this is in spite of absence of FI. FI in the last 3 months, inclusive of November, will have a negative 4.5, close to $5 billion of outflows, right? So these exuberances can get more leg if FI participate. So one has to be cautious, is my understanding.
You mentioned about the recent IPO rush. Anything that's caught your fancy? Of course, Tata Tech, I think one of the 10 best listings ever. 140% kind of a premium. I mean, I think the last time we saw a 200 kind of premium was in 2021, I think Sigachi Industries. But anything from the recent wave of IPOs that have hit the market, anything catching your fancy, anything that you find very promising, especially Tata Tech?
Maybe, Manita, because we at Fident are not we are not in for IPO because of the valuations. This has to be is very very clear. So I would say the valuations of majority of these IPOs are very stretched. There is very little on the table for investors. And if we as a long-term investors, we are not here to just get into applications and sell it on the day of listing. We being long-term investors, we believe it's not in our favor, and history has been in our support. So I would say that there will be 6 7 IPOs out of 100, which possibly can create wealth for investors in long term. In the last 3 to 4 years, I have not seen those many kind of opportunity in the market. Like Tata was a brilliant one because there's not many peers in that segment. There's one KPIT which is there, but being a very strong brand, very strong corporate governance, and we have seen their execution capabilities at ECS and things like that. It was a compelling story for a long term. But valuations were so stretched that there was very little for us to create a compounding case for investment for us. So very, very watchful of the IPOs market.
Right. I also want to get your thoughts on the PSU space. Some of the stocks from the PSU space, I think REC, PFC, the likes, have given a solid 200% kind of a return this year itself. Do you think if somebody wants to enter into these stocks, do you think the risk reward now would be favorable? Is there more steam left? Because one section of the market believes that this could just be the beginning. Would you concur with that view?
So PSU are in favor, and I believe they will remain the flavor of the market because, as I said, the way the government is functioning is giving a lot of confidence not only to the domestic investors but also to the foreign investors. And if you see the data of FI buying over the last 1 year, there has been a remarkable participation of FIs into the PSUs, whether it is your utilities or whether it is oil and gas or even in you look at PFCs and RECs of the world, the stock has gone 3.5 4 times in the last 7 8 months. And I believe this, as I said, this frenzy is expected to remain continued if this policy continue of the government stays put. So I believe there would be a lot of more money which will be made in PSUs, capital goods, utilities, oil and gas, and things like that. But one has to, just jump one big event of May or possibly, the election thing. That is very, very critical in the PSU case because it can completely change the paradigm of, the visibility about growth and all. And historically, if you say the last 15, 20 years, whenever there has been instances of PSUs stocks showing traction and fizzle out with some reason or the other. According to me, the biggest reason would be a change in government, and then possibly you will not be at the mercy of the market. So, incremental investors should be, I would say, should be very very careful. People who have got into PSUs early of the year or last year, possibly they can remain stable because they possibly would be sitting on a huge cash profits or in the profits, so they can take that bunch. But incremental investors should be watchful.
Right. Talking about the large caps, some of them have actually, if you look at the kind of rally we've seen on the NIFTY, surprisingly, some of them, of the large caps, have given negative returns on a YTD basis. Some of the banks, ICICI Bank, a case in point, and Reliance Industries is just starting to show some signs of recovery, right? So, do you think this is the right time when these stocks will play catch up going forward? And you were saying that there is much more room for upside. Do you think these are some of the stocks that could lead to that leg up?
for a rational investors, it's a good time that the portfolio changes should be done. A lot of money which they have been able to made in mid and small caps where valuations have become really, really stretched, that money should be now parked into high quality large caps gradually. Right, as you pointed out about BFSI, last 1 year BFSI has even underperformed Nifty. Right, I'm not talking about the NBFCs in the smaller mid-small size NBFCs, but if you look at like the large cap banks and all of those, the performance is pretty stark. And you say there's always this mean reversion which plays out in the market. So it's visible that you sell 40, 50 PE stocks or possibly 7, 8 times price to book and go in and park your money at 15, 20 P or possibly 2, 3 times price to book banks, and possibly provide solidity to your portfolio, and you will be more prepared to see that volatility which will be there in the market. And if you ask me specifically on banks, that and the only risk that I perceive, even which you have been hearing, RBI has been pretty vocal about, that the possible asset quality pressure which they might hit those banking space in the next 2 to 3 years. So that is one area which possibly can derail the earning growth of those banks. But bank, to me, any bank which is a very strong ALM, who are strong on asset quality matrices, with have deficient capital adequacy, possibly can easily give it over to 15, 17% kind of a return for the next 2, 3 years, given the way our economy is expected to grow. So I believe it will be very rational for investors to park their money into high quality BFSI names, even IT for the matter. Possibly the third quarter will be washed out like what we witnessed in the last couple of quarters. But if you have a 2, 2.5 year view, IT large cap can provide you better returns than many other sectors, similarly like banks. So these are the sectors which has massively underperformed. Even pharma to some extent were started participating, but some allocation to sectors like this can be very, very important later in the coming years.
Right, before I let you go, anything that is looking interesting to you at this juncture, which is not very expensive, and if you advise your clients to look at with a 2 to 3 year perspective, which pocket would that be aside of BFSI? Anything else?
So I think, as I said, I believe IT looks very, very attractive to me. One of the reason being is more than their operational performances, which possibly will take a couple of quarters to come back to the theme, because the recessionary fears in US and Europe possibly are in backstage now. But what really excites me is the softening inflation and the softening of yield globally. And it can really, provide a much needed impetus to the IT sector. And I believe the run up in the large cap IT, this turnaround in operation could be very steep, and it will very become difficult to catch hold of that during that time. So I believe IT is one, large cap IT is one sector which should be looked at. Second one is I like a lot of, auto end companies. I believe that that is one sector which we've been very vocal about it. We've been very positive in the sector whole of 23, and I believe 24 and 25 also hold very good for that. But valuations has become a little stretched. Nothing is available below 1.7, 1.8 time PEG ratio. So any businesses where you believe that the growth of 20 or 30% is doable in auto hang, I believe that is also one sector alongside IT which investors can look at to create healthy returns in the coming years.
Right, auto and auto ank rather, and IT, these are the sectors that's catching Aishwarya's fancy. But with that, Aishwarya, thanks a lot for taking out time and joining in. I wish we could have a longer conversation, but we're running out of time here. We are in fine fettle, and of course next week Monday, when we react to the state poll results, that is something that we'll be of course keenly watching out for, and that would decide whether we are headed up from here at the current juncture, or could there be a little bit of consolidation, that could kick in next week. With that, thanks a lot for joining in. But for our viewers, of course, it's been a great week. We've ended on a high. It's been a record closing high for the Nifty. So 20,280, I think 260 is where we are at, and next week, of course, will be a crucial one. Sunday is the result of the state assembly polls, and we will be reacting to that on Monday. Come back and join in as we bring special coverage on Sunday itself, and then we'll be back with the markets on Monday morning. Thanks a lot for tuning in. You guys have a great weekend.